Okay, I think we should be good now. Let's see. All right, guys, good morning. Good morning. Give me a second. Let me make sure I can send this tweet out. Okay, Twitter was down. Twitter is back up right on time. So that's good news. What's up? What's up? Good morning. Good morning. Okay. All right, we got some news coming in. All right, let me go ahead and retweet this. All right, guys. Good morning, everybody. Welcome aboard to the Morning Note. My name is Carlos Garcia, founder and CEO of G.A.R Capital. It is a beautiful Thursday morning, July 14th, 2022. Here with you every morning, 9 a.m. Eastern Standard Time. Twitter be damned if it's down. We're still here. And good news, Discord wasn't down. So at least our members did get the updated morning headlines and stuff. All right, let's go ahead and get to work. Dow futures down 484 points, Nasdaq down 105 points, down 0.90%, S&P down 1.35%, Russell down 1.5%, 1701. Crude oil continues to falter, down 1.74%, 94.61 a barrel. Gasoline continues to roll over $3.18 a gallon. 1705 for gold futures, that's down 1.8%. Silver futures down 4.84%, 1826 per ounce. And the reason that is because of the dollar. The dollar right here is continuing its soar job. 108.82, up 0.80%. Let's maximize this so we can give a little more context. And again, we've kind of talked about these key levels. Remember, the next level higher, the 61.8 extension, is right at 114.76 based on this weekly chart. This is a 20-year chart. We could continue to grind higher, but right here is where you start really getting a commodities crush, where possibly 114 would probably get you to around $70 a barrel oil, all things being considered, all things being equal, like supply. So that's what's hurting equities. Again, the inverse correlation is there. As the dollar continues to go higher, mega cap stocks, a lot of multinational companies have to pay more money for that currency conversion. So that's what's hurting that end. 10-year yields climbing up slightly, 2.982%, no gaps there. The volatility index, the VIX, bottom left-hand corner of your screen, kind of pulling back from its peak right around 28.21. We're up about 4% this morning. We did get the PPI number as well. Let me go ahead and round off this little pieces of news. Euro dollar right near parity again, down 53 pips. And then you have the dollar yen tapping nearly 140, now 139.12. Bitcoin and Ethereum crypto continues to be higher even with a strong dollar. Now that's something that's interesting. 19,775. If you're someone that's in Europe or Japan and you're pricing Bitcoin in euros or Bitcoin against yen, you're going to be a lot higher, obviously, because that's the arbitrage difference between the dollar and the euro. Ethereum at 1085 as well. So again, if you're looking at your statement euro against our Bitcoin in priced in yen, then yeah, you're going to be happier than someone who has it in dollars. But again, still green. At least some kind of speck of green news there. All right, let's go ahead and go over the PPI numbers. This is the producer price index. I made a joke on Twitter. I said the PPI number was so bad that it broke Twitter. June producer price index rose 11.3%, estimated 10.7%. I had one more headline. Let me go ahead and read that from Twitter, from Bloomberg, because I didn't tweet that information. Okay, so here's the percentages. U.S. June producer prices rise 1.1% month over month versus the estimate of 0.8%. Now, you're probably wondering why I'm doing this on the phone and not on my computer, on the actual terminal. The app for Bloomberg is very, very slick and is very nice. So let's add this other headline here. And it's a lot easier to copy and paste at least just the headlines for you guys on Twitter. If I do it on the actual terminal, it kind of copies all the other things, like kind of extra bits and timestamps and such. So it's like an extra step. So that's why I use the phone. So we have the producer price index high. We have CPI high. That hurts equities. That's bringing up the dollar, obviously, because now we have yields on the front end of the curve being higher, meaning front end inflation expectations are higher, back end expectations are not. So again, I think the longer end curve of bond yields are expecting at least some kind of relief or cutting in 2023 as we're pricing in recession. Now we have twos and tens inverted. We're not in a recession yet, but the warning signs are there. Now, again, just because you have the word recession doesn't mean necessarily stock markets go down. Usually, sometimes around that time, after the recession's announced, you see equities kind of lead the way out. Not right away, but that's happened in '08. That's happened in 2020. Remember, we didn't get out of officially the recession towards the tail end of 2020, toward to 2021. But equities did bounce or bottom right around April, a full, 7 months ahead. Granted, that was helped with the Fed, but with the recession and cutting rates, again, you more than likely will probably get something near that scenario where you get a boost higher with a more accommodative monetary policy. There is no word that will get there. Morgan Stanley is pricing in a February rate cut. So again, rate hikes all the way until December is the expectation. A couple of other pieces of headlines. Amazon announced today its 2022 Prime Day event was its biggest ever. Amazon customers purchased over 300 million items during the two-day event on Bloomberg. I actually did take part of Amazon Prime this year. I did get an extra pair of AirPods to keep at my office. So again, I don't have to go back and forth, and if the battery dies, I don't have to worry. So it was on sale, so I thought it was worth it. Taiwan Semiconductor reported last night or overnight, revenue up 16 billion, up 37%, gross margins up 55%. Oh, excuse me. Revenue 18.6 billion, up 37%. Their gross margin was 59.1%, operating margin 49.1. Those are both beats. CapEx was higher than expected, 7.34 billion versus 5.97 billion. So again, strong numbers from TSM. We did get a upgrade on AMD today. AMD was upgraded, I believe, by Cowen. Let me go ahead and verify that before I get the wrong bank, the wrong credit. AMD, and then we're gonna go over these numbers. It was upgraded to outperform from market perform by BMO Capital. Citigroup cuts Amazon's price target from 205 to 180. Then you have one more piece of the Amazon headlines. Oh, Twitter upgrades. Twitter was upgraded by Rosenblatt to buy from neutral. $52 is the price target now. And I think I had the Amazon news here. It was regarding the antitrust lawsuit in Europe. Let's see. I know I had it here. Well, I'm not going to waste everyone's time by looking for it. It's there. It's regarding Amazon and a EU antitrust lawsuit regarding data selling of their clientele. Let's go over the bank earnings. Morgan Stanley first. Revenue, EPS was $1.44. Let me go ahead and expand this, make life easier. Okay, so $1.44 versus a $1.55 estimate, 13.1 billion versus 13.3 billion. So revenue and EPS were missed. Institutional clients non-GAAP 6.12 billion versus 7 billion, 7.09. Equity sales and trading 2.96 billion, 2.83. So fixed income was to the upside. Wealth management was slightly down. Institutional securities were down, but EPS growth, EPS was down, and so was earnings. So they're actually still profitable, granted, but not expectations. Morgan Stanley expenses impacted by a $200 million regulatory matter. JPM and I believe Morgan Stanley will have their call at 9:30 or 10 o'clock this morning. Equities trading was 2.96 billion, which beat 2.94 billion. So investment banking, that's M&A, that's mergers and acquisitions, that's IPOs. Those were less than expected. I expected the fixed income market to be strong. No kind of color or catalyst in terms of JPM when I read regarding consumer spend, at least in terms of guidance. But Morgan Stanley is not a traditional bank, so we skipped that. JPM had an earnings miss, a suspended stock buybacks, and Jamie Dimon says prepare for whatever happens. So they are increasing their loan loss reserves. Here's the EU Amazon settlement. There it is right there on Twitter. So I did find it. Again, I was tweeting a lot this morning. And then where is that JPM number? Okay, that was earlier this morning. All right, JPM. $12.6 billion. Consumer and community banking revenue was a slight miss year over year. Corporate and investment bank revenue, these are IPOs, again, merger and acquisitions. That was a miss. Banking revenue was down 3.2 billion. That's minus 37%. I believe JPM has went the route of Citibank as well, removing what is this called? Overdraft fees as well. So that's going to hit on the bottom line. I have to go and verify that. I know Citi doesn't have overdraft fees anymore. I think B of A is coming around to that. Markets and insider services revenue, 8.7 billion. That's up 8% year over year. And commercial banking revenue was a beat, 2.68 billion versus 2.4 billion. JP Morgan, Jamie Dimon, the CEO, my favorite CEO on Wall Street, says high inflation, waning consumer confidence, and other factors to have negative consequences on global economy sometime down the road. Here's the meat and potatoes of the actual report, and then we'll get to some questions. $2.76. EPS expectation $2.88. Revenue $31.63 billion versus a $31.98 billion. So that's a miss on the top and bottom line. And again, like we talked about, suspended share buybacks. So you had Morgan Stanley that did buybacks, increase the dividend post their stress test. And then you have JPM hitting a new 52-week low, which I own shares, and Morgan Stanley holding up about 40 cents to the downside. So again, capital return, that's really the only reason you're going to invest really in a bank stock. You're not going to expect tons of growth. But again, JPM taking a hit on that share stop. Good morning. Yep, here we go. In regards to the bank, I just said that, Santiago, my apologies. I was just going through the zone of the bank stocks. Let's go ahead and take a look at both. We can take a look at JPM. We'll go and expand this out to a 3-week chart. And again, we do have that gap to fill around 105.54. I circled that back for a while. So again, if we can go ahead and actually get to around that area and maybe get that gap fill, I will definitely reload on some JPM. Yes, I definitely want to own some. Do you see that inverse head and shoulders on S&P? Do you see it on Qs? Now keep in mind, Qs, I'll only get the 1 hour chart because it's still pre-market. But if you take a look at S&P futures, really it's just a downward channel that we've been getting and still kind of breaking down, but retesting this 3740 level, 3750 level has been holding up really for about 3 weeks. So again, we had that pop. We kind of stayed in this range here, but you could see as we're getting more downside here. Really what you need is to really get back to around 3801 and you need to close above that. So again, we need a 50-point pop and turn this around. Granted, we had CPI yesterday and the stock market ended relatively flat. So again, futures are down with the dollar being up. We know that correlation, inverse correlation. So again, we need the dollar to cool down at least somewhat in order for equities to bounce off this level. So this could be maybe the resistance of the day. If you are an equity bull, if you are bearish, you're expecting the dollar to go higher, at least tag 109, maybe 110. But I don't see any head and shoulders pattern on S&P futures. Let me take a look. Maybe I have to look at the daily. Let's take a look at 4 hour here. Yep, you had the inverse head and shoulders here. Now you're retesting that neckline. So again, now you have peak, and again, that 200-day right there on the 4 hour just seems to be holding. We had an upward trend, broke down below 3850. Now we're back to this level here. Let me just go ahead and draw this. Let's see, drawings. Draw some trend lines again. You can see just by here, that apex there was right around 3800, 3810. Broke down below it, but we still have this right here to hold. But it keeps knocking on the door. Look at what happens next, guys. When we start knocking on that door, we still have that downward gap at 3675. That should be retested. So again, if we go ahead and do the math right now on ES being at 3746, we're probably right around here. If we break 3745 on S&P cash, that's SPX on your ticker, you'll have this gap to fill at 3675. If you're going based on downward channels, you have a lot more to go because you can get down to around 3500. And again, that's still the level that I'm looking for to buy, which is still 3501, 3502. So again, we do have a path down there. We didn't get any help from CPI. We didn't get any help from PPI. Tomorrow we have retail sales. The only really good thing that you can see about the market here, again, since there's really no absolutes, is that at least you're seeing commodity prices go down. So the dollar is hurting commodities now, but looking forward for consumers, that's going to be at least some kind of reprieve. So again, we've talked about that kind of analogy with a cancer patient and chemo being a recession, or an illness. You need a recession to kill inflation. 2008, we had a demand destruction to 2009. We bounced back relatively, took a while, but we did bounce back, obviously, from the great financial crisis. But oil was high at that point as well, and then it rolled over with less demand. How are markets reacting to inflation headlines? Really, the inflation headlines is really based, really didn't move that in headline did not move the needle as much as the dollar did. So again, you can go by just this. What is this? We'll go 839 candle. Really, a little bit of a pump to 37.60 and back down to 37.49, but we're still holding. So again, if you're looking at it in terms of the market, again, you're still just tapping at 37.40 until that breaks. If that does break, you're going to get that gap fill on SPX to the downside. The only issue that you may have is the fact that if the dollar turns around, this support here may just become a little bit of a spring mattress and bounce back, even if we overshoot it. That's the only scary part of that. And again, remember, yesterday we had a really bad CPI number, and we ended the day relatively flat. The S&P was green at one point, so was the Nasdaq, and that's more rate sensitive. So again, right now it's the dollar that's really moving the market in a sense. In terms of banks, yes, I do expect at least some kind of a bounce, but not at this point yet. No, they're putting more money toward loan reserves. They're looking forward and seeing that, hey, if we get some weakness in consumer, or they're really pricing in a recession, again, now you're starting to look at testing this 200-day moving average. And the only time that we've actually broken below that recent last 3 years has been, or 200-day moving average here. If I bring up an actual max weekly, you can see the last time that we broke below the 200-day was right in 2018 when we had the Fed raise rates. We overshot it slightly. This is XLF financial ETF, and then we bounced. So that 200-day has been kind of a really pretty good constant guide. The only time that we've really broken below that is since the great financial crisis, the banking crisis, obviously 2008, was really back in 2012. That's the only time. So again, I think we may be getting to a point that banks are oversold, at least on the 200-day. Again, if XLF hits 30, that might be a nice place to start maybe looking at positioning yourself, because they are cheap. We just got EPS earnings. We don't have any forecasting as of yet, since their earnings call is in about 13 minutes or so. So I think we're just going to look at banks as well. But again, I also have that gap to fill on JPM. So that's another, and I already own the stock anyway, so I definitely want to add more as I go along. But again, you're going to bring up that 3-week, you have that gap to fill 105.54. We're at 108.20 right now on the ask on pre-market. If we get $3 more, maybe that gets us to XLF being at 30. And again, some key levels of support to look at. So again, banks are not sexy, but again, if you're looking for capital return, especially in a down market, at least they are paying their dividends. Granted, no share buybacks. That's what's really hurting JPM. So they want to go ahead and hold their cash. They're playing some defense. Jamie Dimon knows a lot, so he obviously sees something that maybe the other banks may not explain so articulately, let's just say. But we have Citibank, Bank of America, Goldman Sachs on Monday. Bank of America and Citi are tomorrow. So again, we'll get some more talk. Bank of America will probably give us a little more color in terms of the consumer side. So will Citi. Goldman will give us more of the investment banking side. So again, earnings are just starting to pick up. And again, we're going to see what the revisions have in store for us. Do we have down forecasting? What are the expectations from these CEOs? Then we're going to get an EPS estimate for the year on the S&P, and we'll see where that number is and make our decisions moving forward. If we have a little more downside, again, 3,500 is still my level. Let's see if we get there. Have a great rest of your afternoon. I will catch you guys later, guys. Cheers.